Welcome to Deloitte's Debrief Tax Webcast series in Asia Pacific. Our webcast today is from our Geography Updates series and is titled Proposed Enhancements to the Preferential Tax Regimes for Asset and Wealth Management Industry in Hong Kong. My name is Anthony Lau, Deloitte's tax partner based in Hong Kong. I have the pleasure of hosting today's webcast. I have three speakers with me today. Eric Lam, Roy Fan, Nicholas Malkin, all three of them are tax partners based in Hong Kong. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I would like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We will do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you will receive an automated email with CPE certificate after watching for 15 minutes. Next slide. Now, let's look at today's agenda. The Hong Kong government has recently conducted a consultation exercise proposing enhancements to the preferential tax regimes for asset and wealth management industry in Hong Kong. So first of all, we will cover the enhancements to each regime one by one, starting by the Unified Fund Exemption Regime, which we call the UFE regime, followed by carry interest tax concession regime, and thirdly, the Single Family Office SFO regime. Based on Hong Kong's proposed enhancements, we will also do a quick Hong Kong versus Singapore comparison. After we have talked about the enhancements, we will then share our vision of how things may go in the future. That is, going forward, how the enhancements may change PE-VC structure. Last but not least, we will have a Q&A session in the end. Now, without further ado, let's go straight to discuss the UFE regime. Before we talk about the enhancements, Eric, how about you provide a quick recap of the existing regime?
Sure, thank you, Anthony. My name is Eric Lam. I'm a tax partner based in Hong Kong. I'll discuss the proposed changes to the Unified Fund Exemption, which undoubtedly will have a great positive impact to the asset management sector here in Hong Kong. As Anthony said, as a quick recap, the current fund exemption provides tax exemption on profits earned by privately offered funds, regardless of their size, structure, or whether they're centrally managed or controlled, from qualifying transactions as well as incidental transactions, subject to a 5% threshold, where conditions are met. The current definition of fund is modeled on that of a collective investment scheme under the Securities and Future Ordinance. Is rather broad. Because of this definition, which may not cover certain types of funds like sovereign wealth funds, pension funds, and endowment funds, the consultation paper now proposes to cover pension funds and endowment funds. Sovereign wealth funds are already included in the current legislation. And in addition, the current regime states that a business undertaking for general, commercial, or industrial purposes is not a fund and therefore no exemption. Very helpfully, now the consultation paper proposes to explicitly stating that transacting in or deriving any income from qualifying assets under the law would not be regarded as a business undertaking for general, commercial, industrial purposes, and therefore will not preclude it from being defined as a fund for tax exemption purposes. Now, this definition, the expansion and the clarification from the government is of course very welcoming. And as you're aware that the current regime also includes deeming provisions, which attribute taxable income to certain Hong Kong resident investors of a tax-exempt fund. And it is also proposed that to relax the deeming provisions by introducing exclusions, which I will discuss later on. Next slide, please. Now I'll go through the key proposed changes. Now, the first one is the expansion of the scope of permitted assets under what we call the Schedule 16C as qualifying investments. In response to market demands, it is proposed to update the list of qualifying investment under Schedule 16C to include non-Hong Kong immovable property, emission derivatives allowance and carbon credits, insurance-linked securities, interest in non-corporate private entities, loans and credit private investments, last but not least, virtual assets. Now, regarding carbon credits, it's proposed that it only includes those that are traded on the new marketplace set up by Hong Kong's Stock Exchange. In our submission to the government, we have proposed that the government consider expanding the scope to cover carbon credits traded on other marketplaces. And in relation to interest in non-corporate private entities, this is particularly welcoming because the current regimes excludes investments in the likes of partnerships and trust arrangements, which are not corporate entities. Now, this consultation paper also proposes to modify the definition of private company to cover any company whose shares or debentures are not traded on any stock exchange. It is proposed that a company would still be regarded as a private company even though its shares or debentures are traded on a stock exchange in the case of an IPO exit. Regarding loans and credit investments, as we know that loans currently are not allowed under Schedule 16C, and therefore any profits arising from trading of loans or credits or any interest income therefrom would not be exempted. Now, this change would make gains from a sale of loans or private credits and interest income qualified for tax exemption. Similarly, we hope that the loans and private credit investment would not be considered private company, and therefore there's no need to subject to the additional testings under the private company definition. Last but not least, virtual assets, which is an increasingly popular class of assets for private equities. We've seen the onset of Web 3.0 funds, and also it is also quite popular with hedge funds, family offices, and therefore, it's welcoming that the government now includes this type of assets, and the definition is very broad, and it covers Bitcoin, Ethereum, utility and security tokens, as well as stable coins. But please note that it excludes any cryptographically secure digital representation of interest in non-permitted assets, such as Hong Kong real estate. This is to prevent a circumvention of using digital representations of non-Schedule 16C assets.
Okay, Eric, wow, it is really encouraging to see that the government has taken on board the recommendations from Deloitte and other industry players to include additional asset classes like virtual assets as tax-exempt assets. But from your daily discussions with other players in the market, are there any other asset classes that are still not in scope for tax exemption?
Absolutely. I mean, there's still quite a number of other assets which like the government to consider, such as artworks and collectibles. I think overall the reaction from the industry is overwhelmingly positive, in light of the proposed expansion, and to cater for the shifting preferences of stakeholders for now a more diversified and innovative asset classes. So we hope the government would include other assets such as, like I said, collectibles, which are growing in popularity among the family offices. Now, this is the first time since the list was introduced back in 2019 that is being updated. And keeping abreast of the popular and the current investment products is very important for Hong Kong to develop itself, its asset management hub. And we hope the government will continue to update this list periodically in response to market demands. And obviously, as a firm, we will lobby the government to do that. Next slide, please. The next change that I'd like to discuss is about the refinement of the scope of the income eligibility. Under the current regime, incidental transactions, such as interest income, are only tax exempt if they don't exceed the 5% threshold of the total relevant income. And under the consultation paper, it is proposed to remove this 5% threshold. And therefore, what that means is all income derived from qualifying investments would be eligible for tax exemption. And this is very welcoming, for the likes of fixed income and bond funds, because currently, where their main source of income is interest income will not be exempted because, they usually do not, meet the 5% threshold rules. So under the new proposed expansion of this, the removal of the 5% threshold, all the income, arising from the likes of bond funds, would be exempted. Additionally, with the proposed expansion to cover other assets such as virtual assets, we also suggested to the government to confirm that tax exemption applies, to other types of income arising from virtual assets, such as staking income, will also be included, in the proposal. Next slide, please. The next key proposed change is about the expansion of permitted activities of special purpose entities. Now, currently, an SPE, special purpose entity, is eligible for tax exemption to the extent of beneficial ownership in the SPE by the fund. And an SPE is defined to mean that it's an entity that's wholly or partially owned by the fund that is established, very important here, solely for the purpose of holding and administering Schedule 16C assets or investee private company. In other words, under the current legislation, the special purpose entity cannot provide any financing or any management services to the private company. Because of this restriction, and SPEs are very commonly used in structures, the consultation paper now proposes to expand the permitted activities to cover the acquisition, holding, administering, and disposal of investee private companies. Now, we welcome the proposed expansion, but we hope the government will also expand the scope of the permitted activities to cover all Schedule 16C assets, and not just the investee private companies as it is currently drafted in the proposal. Also, to cater for different commercial and practical needs regarding the SPEs, we suggest the permitted activities to include also not just financing, but explicitly stating, for example, management of permitted assets. This will obviously favor any tax treaty claims, given that there would be more substance for the SPEs. That could help with any tax treaty claims. The other change regarding SPE is the introduction of a de minimis rules. Currently, the paper proposes a de minimis rule whereby if the fund has at least 95% of beneficial interest in the SPE, it will be fully exempt. They are concerned in the industry that the 95% ownership, it's too high, and that would reduce its appeal and practicality. For example, co-investors typically hold more than 5% in a co-investment vehicle, and therefore the proposed 90% threshold will likely to be too high. So in this regard, we have suggested the government to remove the ownership and implement other anti-abuse provision instead. For example, make reference to the anti-round tripping rules under the fund exemption. This would allow co-investors without any taxable presence in Hong Kong to not expose to tax in Hong Kong solely by investing in the SPE. Next slide, please. Next slide, it's the removal of tests which are applicable to transactions in private companies. As you know, now the current regime, if a private company, if an investment in a private company, it's subject to additional tests called the holding period test, the control test, and under the short-term asset test. Under the current regime, a private company, the fund will not be tax exempt where the private company has been held for less than 2 years, and under the control test, the fund has control in the private company, and also the private company holds more than 50% of its asset in terms of short-term assets. Now, next slide, please. The government now proposes to remove the last two of the tests. Now, this is not ideal if you think about it, because removing the last two tests, i.e. the control and the short-term asset test, actually would make the exemption scope narrower. So, for example, if a fund has a minority stake in a non-property rich private company with no control, under the current regime, as long as it has no control over the investments, even if we don't meet the holding period test, it would still be exempted. But with the proposed removal of the last two tests, under the same scenario, if you don't meet the holding period test, that would be the end of it. There would be no exemption. As such, we have suggested the government to remove the holding period test, as well as the control test and the short-term asset test, to make it more user-friendly. Next slide, please. The next change is to do with the deeming provisions. As we know, that there's a deeming provision whereby if there's tax-exempt fund and they are Hong Kong resident investors, those could be caught depending on the percentage of investment in the fund. Now, under the proposal, it is proposed to relax this rule if the investors are Hong Kong resident investors, or Hong Kong, being either individuals or entities held by them, or other Hong Kong resident entities that are not business undertakings or carrying on a trade of business in Hong Kong, or a tax-exempt funds, this would be excluded from the deeming provisions. Now, this is particularly welcoming because a lot of the time we see our clients, have their Hong Kong resident employees of the fund manager investing their own money into the funds. Under the current legislation, this would be caught by the deeming provisions. But under the new rules, this would be relaxed and would not be caught by the new proposed rules. Next slide, please. Coming up to the last proposed changes regarding tax reporting and substantial activities. The paper proposes a tax reporting mechanism if the funds and the SPEs make use of the fund exemption. Now, this is not, very welcoming in light of the fact that currently the fund exemption has always been on a self-assessment basis. You don't need to get approval or reporting, by or to the Inland Revenue Department. So we have suggested to the government that to keep the reporting, and the requirements as simple as possible. Also, with guidance provided on, actually when the mechanism does roll out, the government should seek, another consultation from the industry, just to make sure that this is not a showstopper for funds to stop using the funds because of the level of reporting that is required. Now, in light of the substantial activities, i.e. needing a minimum 2 employees and incurring 2 million Hong Kong dollars, this is not new. It's in line with what we have for the carry interest concession and also the single family office concession. So I don't think that is going to be a real, a red flag. But bear in mind that outsourcing of the investment services is allowed, and assume that when the guidelines does roll out, it would be quite similar to what that's applicable to the carry interest and the family office concessions. So just very quickly, I've just highlighted all the key changes proposed in the consultation paper. That's all the changes for now. Next slide.
Thank you, Eric.
Yes, Anthony.
Now, that brings us to the first polling question of the day. Now, which proposed changes to the UFE do you find most welcoming? And your options are refinement to the scope of income eligibility, removal of the 5% threshold, expansion of the scope of, assets called as qualifying investments, expansion of permitted activities of SPE and de minimis rule for co-investments, simplification of the taxes applicable to transactions in private companies, and relaxation of the anti-round-tripping rules or dimming provisions. Now, while we are waiting for the results to come in, Eric, I understand that there have been long-standing concerns that under the existing regime, funds of one, that is, funds having one investor only, may not be able to benefit from the regime. That is because funds of one may not satisfy the pooling arrangement and hence may not be regarded as collective investment schemes. Does the consultation paper suggest any change in this respect?
Thank you, Anthony. Good question. Unfortunately, the consultation paper currently does not mention the funds of one. Like you said, given that it might not be covered under the current definition, collective investment scheme. We hope the government would appreciate that the funds of one are really commonly used in the wealth and asset management industry today for commercial reasons. And in essence, to a lot of the people are no different from other investment schemes commonly perceived as funds by stakeholders. The only difference is that it is not a collective investment scheme per se under definition, but other conditions such as no day-to-day control, and the investor itself is not in the same corporate group as the fund manager. We believe the regime should offer a level playing field for different types of investments, and in which funds of one should not be disadvantaged because for commercial reasons it is being used, and have indeed, we've submitted our views to the government accordingly.
Hey, thank you, Eric. Let's look at the results. As expected, close to 50% of the attendees, they welcomed the expansion of the scope of, tax-exempt assets. And then the next most popular, enhancement will be the removal of the 5% threshold. That 5% threshold has caused many issues for fixed income funds. Okay, so now let's move on to the next topic of today's webcast, carry interest tax concession regime. Now, on the carry interest tax concession regime, this has been effective, from April 2020. But so far, it does not seem that many PE VC players have applied for the 0% tax treatment. Nick, can you please take us through the existing regime, in particular, the practical difficulties in meeting the conditions and the proposed enhancements? Thank you.
Thank you, Anthony. As you mentioned, the proposed consultation, proposes to streamline the existing regime, and the government indeed proposed several welcome enhancements to the existing carried interest tax concession regime. We've included a recap here of the current regime in the slides. The first thing to note is the regime, as you said, took effect in May 2021 and is applicable for eligible carried interest, which is received or accrued on or after 1 April 2020. It should be noted that the existing carried interest tax concession regime does provide for full tax exemption in Hong Kong for in-scope transactions. The regime provides both profits tax and salaries tax exemptions for eligible carried interest. This is clearly very tax efficient and compares favorably to other jurisdictions and financial centers globally, including compared to Singapore. Singapore typically does not provide for exemption on the receipt of carried interest. So Hong Kong's current regime still remains favorable. As you note, there are a number of requirements to be met to benefit from the existing Hong Kong regime, but these conditions are seen by the industry as onerous to fulfill and cumbersome to meet. They can be especially difficult to be met in practice by more complex operators, sort of including sort of regional and global asset managers, as they typically will often form complicated and bespoke structures relating to carried interest. And in particular, one point we would want to make is that under the current regime, the tax concession only applies to carried interest paid out from a qualifying carried interest payer, which is an investment fund which is certified by the Hong Kong Monetary Authority. And this is a point that will come back as we discuss the consultation later on. But as part of the certification requirement under the current regime, the fund or its investment manager is required to prepare an auditor's report and submit it to the HKMA. But however, even after you've gone through this process, being an HKMA certified fund does not automatically qualify the carried interest distributed by such a fund for tax concession. The fund will be required to submit relevant carried interest information to the IRD for further assessment. So due to the complexity of the existing arrangements involving both the HKMA and the IRD, we're aware, based on discussion with industry players, that very few asset managers have gone through the process to benefit from the exemption in practice. It's therefore very good and encouraging to see the consultation proposing to simplify the requirement to be met in order to benefit from this exemption. In particular, the need for the carried interest to be in respect of qualifying transaction is being expanded, and that's something that will go on in the next slide. So next slide, please. So here we've outlined one of the key proposed changes in the consultation, which is the removal of what we're calling the routing requirement. So the current concession regime requires the fund to allocate carried interest through a qualifying person as defined, which is typically a Hong Kong entity, such as a fund manager or a fund investment advisor. The qualifying person should either be a Hong Kong SFO licensed corporation or an authorized financial institution, or alternatively, a person providing investment management services in Hong Kong to a qualified investment fund. In practice, however, as noted in a previous slide, the arrangements can be very bespoke and complex, and it is very common for carried interest recipients, i.e. the qualifying employees of the fund manager, to receive carried interest by an offshore SPV or a carry vehicle due to various non-tax commercial reasons. This flow of carried interest does not meet the criteria for exemption under the existing regime. But as part of the consultation exercise, it's proposed to remove the routing condition and to broaden the scope of qualifying payer to include associated corporations or an associated partnership of a certified investment fund, as we've depicted on the slide. The expansion aims to include closely related entities of the fund, which provides really much greater flexibility on the distribution arrangements to qualifying employees. Under the proposed changes, the carry vehicle of offshore SPVs are now expected to directly distribute carried interest to qualifying employees without the need to interpose a qualifying person in the structure.
Yeah, Nick, I mean, it's really good to see that the government is proposing to remove the routing condition. That has caused many issues for our PEVC fund clients in relying on this carry interest tax concession. Now, but I understand that another big, question that the industry has with respect to this regime is that for the carry interest to qualify for the 0% tax treatment, it has to arise from certain types of qualifying transactions. If the profits are not arising from such qualifying transactions, there won't be any tax concession. Now, for example, under the current regime, if the fund's profits are arising from transactions that are not managed or arranged in Hong Kong, the carry interest from that profits will unlikely qualify. Nick, do we expect any change to that?
We do, and that is part of the consultation exercise with a view to sort of broaden the scope of these qualifying transactions. So if we could go through to the next slide, please. So here, as you can see on the screen, the second key proposed change that we want to discuss is the expansion of the types of transaction which give rise to eligible carried interest for this exemption. So under the current regime, as mentioned, eligible carried interest only arises from certain very specific transactions, i.e. it must arise from transactions that either involve instruments of private companies or issued by private companies, or SPEs or interposed SPEs, which are solely holding and administering investee private companies. So this is fairly narrow in scope. The last condition, can include incidental transactions to carrying out of these various eligible transactions. But it's good to sort of see the expansion to these proposed changes that we've outlined on the right, in particular, broadening to the qualifying transactions to include the fund's tax-exempt profits in general under the UFE regime, which sort of ties in to what Eric has just described. Other non-taxable transactions, such as offshore income, or for example, dividend income, would also generally qualify. And then there's other taxable income. So the devil is very much in the detail in terms of what will be included in the legislation. But generally, the expansion is very welcome, especially as we know Hong Kong's got a territorial tax regime, which means that a number of offshore transactions may suddenly qualify, and eligible carried interest paid therefrom may therefore come into the scope of the exemption. So a very welcome change to monitor. Next slide, please. So the third key proposed change is the removal of the hurdle rate requirement and the removal of the requirement for an HKMA certification. So under the existing regime, to qualify as eligible carried interest, the payment can only arise after the payment of a hurdle rate or return on that hurdle rate. In practice, as we know, hurdle rates sort of commercially agreed between investors and LPs and fund managers, and are typically agreed on a case-by-case basis and are very, very bespoke in nature, and can be subject to many changes and a number of complexities. There are instances, as acknowledged by the government in the consultation, where there is no hurdle rate under the agreements. And as such, this removal of the condition is a welcome sign that the government is looking to streamline the process to seek exemption for on the payment of eligible carried interest. In addition, as mentioned at the beginning of my presentation, qualifying persons must provide investment management services to a certified investment fund, i.e. a fund which is within the meaning of Section 20 AM that is certified by HKMA. The HKMA certification requirement is also removed and will very much simplify the application process and effectively leave the assessment to the IRD rather than a joint assessment. We welcome in general the removal of these two conditions. They're often seen as too onerous and not in line with what other people are doing commercially and what is also done in other jurisdictions with respect to special treatment related to carried interest. So in summary, when reviewing the consultation paper, we think it's encouraging. The government is proposing to streamline and simplify the entire process. When deciding to expand into Hong Kong, the asset managers will typically look at a number of factors, and having both a robust unified fund exemption regime as well as a pragmatic and streamlined carried interest regime will tick two very important boxes, and we hope convey a strong positive message to the industry. Thank you.
Hey, thank you, Nick. You are a very good salesman, right? And apart from being a tax professional. So now let's look at the second polling question of the day. Okay. Now, in light of all these proposed changes, will you seek to avail of the tax benefits under the UFE regime and carry interest tax concession regime? And your options are yes, no, don't know, wait and see. Okay, now while we are waiting for the results to come in, okay, Nick, we have talked about many enhancements which are good and what the industry is really looking forward to. But there's always room for improvement, to make the regimes more user-friendly and appealing to industry players, to attract them to manage, investments in Hong Kong. What else the governments can do?
So, I mean, one of the things that we've indeed included in the consultation paper is the suggestion of a creation of a task force, not tax force, that will effectively be there and be present to accompany asset managers and industry players as they look to expand their presence in Hong Kong and benefit from these enhancements. As mentioned, the devil is very much in the detail, and having a close relationship with the IRD will enable investors looking to expand their presence into Hong Kong to make decisions and hopefully, as you say, look to expand their presence into Hong Kong and use Hong Kong as a platform to make investments into Asia.
Yeah, so now let's look at the results, right? I mean, we are not surprised that, close to 50% or more than 50% of the respondents, will take a wait and see approach. I mean, this is understandable because the enhancements have not been enacted into law yet. But based on our interaction with many of our clients, I think a lot of them, consider these regimes after the enhancements to be fairly attractive. And, as Nick mentioned before, to ensure that the final legislation can address the practical considerations of the industry with a reasonable degree of flexibility and certainty. We encourage the government to continue to involve stakeholders in the coming drafting process. Okay, now let's look at the another topic, the SFO regime. Now this regime only came into operation in May 23rd, but this regime has indeed been very successful in attracting high net worth individuals coming to Hong Kong to set up single family offices over the last 20 months or so. Just for Deloitte, we've already secured over 70 single family office tax advisory engagements. Now, Roy, can you walk us through why this regime is so attractive? And if it is so attractive, why do we need any enhancements?
Yeah, sure, Anthony. So as a quick recap, the tax concession regime was launched in 2023 with retrospective effect from 1st April 2022, and it was aimed to attract high net worth individuals or families to establish their single family offices in Hong Kong. So let's say we have a wealthy family that has established a single family office, we call it SFO in Hong Kong, to manage the investments held by a family-owned investment holding vehicle, we call it FIHV here, whereby both the SFO and FIHV are at least 95% owned by that wealthy family. If the relevant condition under the SFO regime, such as the minimum AUM requirement of Hong Kong dollar 240 million, which is equivalent to around 30 million US dollar, and the substantial activity requirement of having 2 full-time employees in Hong Kong and incurring annual operating expenses of Hong Kong dollar 2 million can be satisfied. Then the income derived by the FIHV from transaction in qualifying asset would be exempt from Hong Kong profits tax. As the SFO regime is largely modeled based on the unified fund exemption regime that we have gone through earlier, the definition of qualifying asset is actually the same as those under the UFE regime. Similarly, the additional tax for PE investments and the 5% threshold on incidental income would equally apply under the SFO regime. Next slide, please. Given the SFO regime is largely modeled based on the UFE regime, we can expect that the proposed enhancement to be made to the UFE regime would also apply to the SFO regime. In summary, that include the following key aspects. Number 1, to expand the scope of qualifying investment or assets to cover virtual asset, loans and private credit investments, long Hong Kong immovable properties, etc. This is welcomed by the industry as we do see more and more family offices invest into these asset classes. Having said so, we also recommend the Hong Kong government to consider further expanding the list of qualified assets to cover other asset classes such as art piece, collectibles, and insurance policy with the investment feature, which family offices or high net worth people are keen to invest into. Number 2, same as the UFE regime, the 5% threshold on incidental income is also proposed to be removed under the SFO regime, which is definitely a good news for single family office that invest in debt securities, loans, and private credit on a buy and hold strategy, which mainly generate interest income, which is considered as incidental income for the purpose of SFO regime. Similarly, the additional tax applicable to PE investment will be simplified by removing the control tax and short-term asset tax, which we don't agree, and the activities of the FSPE, which is a special purpose entity SPE owned by FIHB, will be expanded to cover the acquisition, holding, administering, and disposal of qualified assets and activities incidental to those activities. Next slide, please. With the proposed changes to the UFE regime and the SFO regime, an interesting question here is whether multi-family office, MFO, could benefit from it. Let's look at an example here. Assuming a FIHB is 90% owned by family A and 10% owned by family B, as shown in this structure or diagram. Family A and family B are both Hong Kong families, and this FIHB is managed by a MFO, which let's say is 100% owned by family A. Under the current SFO regime, the FIHB here is unable to qualify for Hong Kong tax exemption because it is less than 95% owned by any single family. Besides, in order for the SFO regime to apply, the MFO cannot derive more than 25% of its accessible profits from third parties, i.e. parties that are unrelated to family A. On the other hand, if we consider the FIHB as a fund, would it be able to qualify for tax exemption under the UFE regime? The answer is potentially yes, provided the MFO is licensed under the Securities and Futures Ordinance. However, under the existing UFE regime, there is a dimming provision, which would apply to dim 90% of the accessible profits of the FIHB as taxable in the hands of family A, which is a Hong Kong resident. That being said, with the proposed carve-out under the dimming provision to exclude Hong Kong resident individuals and their SPV from the application of the dimming rules, it appears that the dimming provision may no longer apply to family A in the future in this structure. And therefore, the UFE regime would be effective in terms of providing Hong Kong tax exemption in similar structure. Next slide, please. The enhancement to the regimes could potentially also allow flexibility to transform a SFO, single family office, to a multi-family office, MFO, while remaining tax efficient at the same time. Let's again use an example to illustrate this idea. On the left-hand side, you can see a typical single family office structure whereby there are two FIHB 100% held under a family trust. The two FIHB are managed by the eligible single family office, which is also 100% held under the same family trust. Assuming the requirements under the SFO regime, including the AUM requirements, substantial activity requirements, are satisfied, then the two FIHB should be exempt from Hong Kong profits tax on income derived from transaction in qualified assets. In practice, we do see high net worth clients, after having set up a single family office in Hong Kong, will have an intention to transform this SFO to a MFO in the future so that they can manage third-party monies in the future. Apart from the requirement for the MFO to obtain a SFC license for managing third-party monies, it is worthwhile to note that if in the future the MFO derive management fee or other income from third parties, which constitute more than 25% of its accessible profit, then the FIHB managed by the MFO would no longer be be eligible for the Hong Kong tax exemption under the SFO regime. Besides, the deeming provision under the current UFE regime would impose a deemed tax at the shareholders level for those shareholders that is Hong Kong resident people, even if the FIHB seek to rely on the UFE regime for tax exemption. Therefore, under the current legislation, the high net worth clients would likely need to use a separate entity to apply for SFC license and act as MFO going forward, instead of transforming his or her SFO into MFO. In other words, that client would need to keep two entities, one as SFO and one as MFO, which means higher maintenance costs and even more complication would arise if both entities are actually managed and operated by the same investment team. With the proposed enhancement to the UFE regime, particularly with the relaxation of deeming provision by carving out Hong Kong resident individual and their SPV, we see that there are now opportunities for the SFO to transform directly into a MFO while remaining tax efficient. To illustrate this idea, let's refer to the structure on the right-hand side, which shows that the MFO is held under Family A's trust. Apart from managing Family A's FIHB, which is held by the same trust, the MFO also manages FIHB of Family B, which has no relationship with Family A. Assuming the MFO derived management fee from Family B, which constitute more than 25% of its accessible profits, in such case, the MFO is not an eligible single family office, and therefore the FIHB of Family A cannot enjoy the Hong Kong tax exemption under the SFO regime. That being said, Family A's FIHB and Family B's FIHB would appear to be able to enjoy the Hong Kong tax exemption under the UFE regime, provided there is an external shareholder or investor at each FIHB level, and the MFO is an SFC licensed entity. As explained in the previous slide, the proposed relaxation of the deeming rules would likely benefit Family A and Family B, which are Hong Kong families, in the current case, whereby no deemed accessible profit would be charged at their level, which means the UFE will be effective in providing Hong Kong tax exemption in those structures.
Okay. Oh, thank you, Roy. Wow. These are all very complicated concepts. Okay. Maybe we'll go to the next slide. Now, while we talk about the Hong Kong's preferential regimes, right, we often come across with one question. What is Singapore doing? Given Singapore also has similar preferential tax regimes. Now, for instance, I know that Singapore's current regimes do not specifically cover virtual assets, but Hong Kong is now proposing to expand the scope, to allow virtual assets qualifying for tax exemption. Now, this is a very busy slide, Roy, but can you just spend maybe 2 minutes to walk us through the key differences, between the different regimes in Singapore and Hong Kong?
Yeah, sure, Anthony. So this slide shows a comparison between the relevant regime in Hong Kong and Singapore. In Hong Kong, we have the UFE regime for funds and the SFO regime for FIHB managed by the single family offices. In Singapore, we highlight 13O and 13U regime here, which apply to both funds and SFO. So first, when we look at the qualifying investment, one key differentiation between Hong Kong regimes and Singapore regimes, as Anthony has pointed out, is that virtual asset is now proposed to be covered in Hong Kong, but not in Singapore regime. Besides, there is a local investment requirement under the Singapore regime, whereby 10% of the investments, and which is capped at Singapore dollar 10 million, would need to be allocated to specified investment in the Singapore market. There's no such local investment requirement in Hong Kong. In terms of the ownership requirement, the UFE regime has a pooling requirement which requires at least 2 investors, while the SFO regime requires at least 95% ownership by member of a single family. Under the Singapore 13O and 13U regime, there's no specific ownership requirement. Another key differentiation between the Singapore and Hong Kong regime is that the Hong Kong regime apply on a self-assessment basis, whereby the 13O, 13U regime in Singapore would require peer approval by the Singapore MAS. With the proposed enhancement, The UFE regime also require local substance requirement, which is same as the SFO regime, i.e. Having 2 full-time employees and annual operating expenses of Hong Kong dollar 2 million per year. While the UFE regime does not require the fund vehicle to be managed or controlled in Hong Kong, the SFO regime in Hong Kong does require the FHB to be normally managed or controlled in Hong Kong. Comparing to Hong Kong, under the Singapore regime, there is also local substance requirement, which in fact is a bit more stringent than the Hong Kong regime. For example, Singapore required all local employees to be Singapore residents and at least one of them being long-family member, while there's no such requirement in Hong Kong. Again, there's no AUM requirement under UFE, and the minimum AUM under SFO regime is approximately 30 million US dollar. In Singapore, the minimum AUM for 13O is around 15 million USD and around 35 million USD for the 13U regime. So overall speaking, while there are many aspects that the Hong Kong regimes are very similar to the Singapore regime, but we do see the Hong Kong regime appear to be more flexible because there's no pre-approval requirement, there's no local investment requirement, and with the proposed enhancement, you can potentially cover more asset classes, in particular virtual assets, than the Singapore regime. So I think that pretty much summarized the comparison between Hong Kong and Singapore regimes.
Okay, thank you, Roy. Okay, now let's move to the final topic for today, right? Now, we have talked about the proposed enhancements to different preferential tax regimes. But what does that mean to you, our clients? Going forward with the enhancements, what are the possible changes to PEVC structure? Particularly on how we structure or operate our funds in order to avail of the tax benefits. Nick, can you walk us through? Thank you.
Thank you, Anthony. So yes, in the next 2 slides, we're going to compare and contrast the current fund structures, which are used by many funds operating in Hong Kong. We'll then follow it by a review of potential changes that we expect to see coming through in the coming years, both based on the trends we see in the wider industry and in particular as a result of the consultation that was launched by the Hong Kong government. In the first slide, we've depicted a typical offshore Cayman fund structure, which we see very commonly in Hong Kong under what we call an advisory model. So the fund is set up as a Cayman limited partnership with its general partner and the fund management company, both being established in the Cayman. The Cayman fund manager then enters into an investment advisory agreement with a Hong Kong investment advisor, which houses the deal professionals and other support staff that are based in Hong Kong and may further subcontract to other supporting investment advisor firms, potentially in the PRC, but also in other jurisdictions in the region. As I said, this type of structure is long-standing, has been in place for a number of years, but we're increasingly seeing more challenges coming through in a number of different areas that we've listed briefly on the right. The first one is economic substance laws. They're being introduced, in particular the Cayman Islands. They've implemented an economic substance law, and fund management is one of the relevant activities which is within scope. So Cayman fund manager is now required to either fulfill substance requirements in Cayman or establish its tax residency elsewhere, such as in Hong Kong. Therefore, the costs of actually having an offshore Cayman fund manager are increasing, and we would expect them to continue to do so in the coming years. So that's sort of challenge number one. The second one is more from a tax and sort of transfer pricing risk. So the IRD in Hong Kong regularly scrutinizes offshore fund structures where they see substantial fund management activities are carried out through an investment advisor in Hong Kong. From a fund management perspective, the IRD can typically raise challenges in 2 main areas. So firstly, whether the offshore entity, such as, for example, a Cayman fund manager, carries on a business in Hong Kong through the Hong Kong investment advisor as an agent, or secondly, whether the actual fee that is being paid to the Hong Kong investment advisor, which is often calculated on a cost plus basis, is reasonable from a transfer pricing perspective. Again, this is something that we expect to see increasing challenges in the context of OECD scrutiny and a number of different areas. The other point, tax incentive under tax treaties. Claiming treaty benefits is typically more and more difficult. So having an offshore structure held through Cayman or even the BVI can make it more difficult to claim treaty benefits due to the lack of actual genuine demonstrable business substance in a jurisdiction. Hong Kong has relaxed its requirements to issue tax residency certificates. But in some cases, for example, under the Hong Kong-Japan Treaty, it's still required to demonstrate business substance and actual presence in Hong Kong in order to be issued a COR. The last point with respect to redomiciliation. So we've seen a global trend to move fund management entities onshore and to redomicile funds and fund SPVs. Singapore has benefited from this trend over the last few years, and Hong Kong is also rolling out its redomiciliation regime. We expect LPs and investors to increasingly request for an onshore fund structure as part of a trend of good fund governance. So definitely something that we expect to see more from a redomiciliation perspective. Next slide, please. So sort of contrasting with the previous slide in terms of what we expect for future fund structures, future operating models, we expect to see many more onshore structures. We've depicted in the slide some of these sort of key changes that we expect. To analyze the impact, it's important to consider each entity and to determine how they will be taxed in an onshore setting. From a fund level, obviously, as discussed by Eric in detail earlier, the extension and the expansion of the various tax exemption under the UFE regime means that the fund structures will generally be increasingly more tax efficient without the need to maintain an artificial offshore presence in a tax haven. So definitely something that is a trend to continue to see. From a Hong Kong fund manager perspective, we expect to see it will be increasingly difficult for management fees to be exempt from taxation, any taxation. Hong Kong, with its low rate of tax at 16.5%, will be helpful in making it attractive as a location for a fund manager to be established in conjunction with the carried interest exemption regime, which I discussed earlier. In addition, obviously, Hong Kong has a territorial tax regime, and the opportunity will remain to try and lodge an offshore claim and to claim a portion of management fee income as derived outside of Hong Kong and exempt it from Hong Kong profits tax, which would then further reduce the effective rate of tax at which management fees paid by the fund are taxed. The last point, obviously, tax incentives under tax treaties in an environment where tax authorities increasingly look at genuine business substance and assess local presence in a very granular manner. Concentrating presence in one onshore jurisdiction is likely to provide benefits, potentially enabling to claim additional tax incentives, although obviously subject to more of a case-by-case analysis. So I think in summary, just looking at potential changes in terms of operating models, asset managers are obviously going to need to assess the downside risk of the various sort of structures by comparing the various costs. These include the tax cost of a challenge by the tax authorities in the countries in which they invest and operate, but they also include the cost of from a reputational standpoint, from the perspective of LPs and investors. This is especially the case with large investors, large fund investors, such as, for example, sovereign wealth funds, which have extremely stringent governance requirements. So we expect that moving towards an onshore fund structure is something we'll continue to see, and will hopefully alleviate these tax concerns and reduce tax risks.
Hey, thank you very much, Nick. We are running out of time, but I do see one very interesting question raised by the audience here. So maybe I will still ask one question. Okay. Now, the question is, apart from the single-family office regime, I've heard that the government has launched the capital investment entrance scheme. So, I mean, that's basically the investment immigration scheme here in Hong Kong. To attract high net worth individuals to come and invest in Hong Kong. How does the investment immigration regime interact with our single family office regime? And maybe Roy, would you like to answer that?
Yeah, sure, Anthony. Yeah. So this CIES regime was actually relaunched last year to attract high net worth individual to come to Hong Kong by investing Hong Kong dollar 13 million in certain permissible assets in the Hong Kong market. Currently, the scheme requires this 30 million investments to be held under the individual's name. That being said, the government has recently announced to make some enhancement to the CIES regime, which will be effective from the 1st of March this year. One of the enhancements is actually to allow the 30 million investment under the CIES regime to be held by a FIHV managed by an eligible single-family office in Hong Kong. So in other words, imagine if we got a high net worth client or individual that has set up a single-family office in Hong Kong, and out of the 240 million AUM managed by that SFO, if 30 million is allocated to the permissible asset class under the CIES regime, then that means he and she could this high net worth client could potentially apply for Hong Kong residency under the CIES regime as well. So I guess this question came in a perfect timing because this proposed enhancement was actually released by the government just a few days ago.
Okay, hey, thank you, Roy, Nick, and Eric. And special thanks to all our attendees here who were able to join us. Now, we would like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you joined us late, please note that this presentation will be archived for future viewing. If you feel that others will benefit from this webcast, please share the webcast via the share this icon or have them visit the debrief's website. We will respond to all the questions submitted during the webcast in a couple of weeks. Also, if you think of any other questions or comments later, please feel free to reach out either to me or our speakers. We'll be more than happy to talk to you. And please don't forget to tune in to our next scheduled webcast from the Geography Updates on 23rd of January, titled Preparing for Australia's New Public Country-by-Country Reporting Measures and Increased Tax Transparency. At last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Goodbye.